Disney reported their fourth quarter results. We'll come in here, take a look at the key numbers, and take a look at it from a technical perspective. This one is looking interesting from a price action. As always, if you are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. Disney, ticker symbol DIS, reported their results. Shares are popping in the after hours, nearly 3.3%, up to $87.30. This company is down nearly 5% year to date, still down over 15% over the past 1 year, and still has a monstrous market cap of over $154 billion. We'll see if that is justified, but they reported their Q4 revenues did miss, but earnings did come in with a beat. We'll get into those numbers in just a second, but Disney's flagship Disney Plus streaming services added nearly 7 million subscribers in the fourth quarter. That reached a total of 150 million paid subscribers globally, and their ad-supported tier also hit 5.2 million paying subscribers, a nearly 2 million subscriber gain in this quarter alone. Now, Disney CEO Bob Iger did say on the conference call that Disney is outlining 4 key areas of focus moving forward, which include profitability in streaming, transitioning ESPN to the preeminent digital sports platform, improving the output and economics in the film studios, and growing its experiences business. And in the past, Disney has also said that they were planning to acquire the rest of the stake in Hulu from Comcast. So Comcast right now owns the last 33% of stake in Hulu, and Disney is looking to acquire that, and we'll see if that is justified from their balance sheet. Now, Bob Iger did admit Disney movies have gone crappy, and that is a bold statement coming from the CEO himself, admitting that the studio prioritized quantity over quality. And again, that is a bold statement. That is, I guess, step one in acknowledging that the movies over at Disney have to become better and, frankly, improve in their quality. Now, ESPN did announce that they are moving likely to a direct-to-consumer and more so a streaming service, and that will likely happen in 2025. And while Disney hasn't disclosed any details regarding the price for the ESPN service, some analysts have estimated that a minimum cost of around $30 a month would be needed in order to just break even, let alone turn a profit. And to me, that is very interesting. $30 a month on an ESPN streaming service, that is certainly a lot of money, and I don't know if consumers will frankly be able to shell out $30 a month for an ESPN service. We'll frankly get into that when the road comes. But onto this most recent quarter, this was Q4 over at Disney, and so they have their quarter ended September 30th, 2023 on the left-hand most column, and then they also have their year ended representing the year-over-year outlook on the right-hand side. So revenues coming in at $21.2 billion. That did miss by roughly $170 million on that top line. Disney doing a good job controlling costs and expenses as those declined nearly $500 million. Now, they did experience a nearly $1 billion restructuring and impairment charge as they are right-sizing the company, and rightfully so. Bob Iger coming in there and controlling costs over at Disney. So they are experiencing this one-time restructuring and impairment charge. You see over the last 12 months, that restructuring charge has been nearly $4 billion. So certainly Disney over the last 1 year right-sizing the company and experiencing that one-time restructuring expense. And so that, again, we'll see. Hopefully that is playing into the favor of Disney over the long term. Now you see income from operations in this most recent quarter coming in at $1 billion. That is up significantly from same time last year. If you grow your revenues by nearly $1 billion and control your costs by nearly $500 million, yeah, that will help your income from operations. And you see net income nearly doubled year over year on a quarterly basis over at Disney. So certainly strong growth on that profitability side, considering Disney is doing a good job managing expenses. They also did say that for fiscal year 2024, they are expecting to reduce their cost base by nearly $7.5 billion. Previously, they had announced that they would reduce their cost base by just $5.5 billion. So Disney doubling down on the reduction of their cost base for this upcoming year. Certainly, I think that is a good thing, considering how really weak their balance sheet is. And earlier we talked about Disney acquiring that remaining stake in Hulu. And frankly, I don't know where they will get the money to do that from. Likely raising capital through the form of share dilution. Even over the last year, you see Disney shares outstanding have increased up to 1.83 billion shares. You see a year ago, we were at just 1.82 billion shares. So again, I think Disney acquiring that outstanding stake in Hulu, that will likely come from share dilution, considering they frankly just don't have enough assets on their balance sheet. You see cash and cash equivalents did rise year over year up to nearly $14.1 billion. Receivables stayed roughly flat at $12.3 billion. You see total current assets coming in at $32.7 billion, but Disney does have a fair amount of current liabilities, nearly $20.6 billion in accounts payable, and total current liabilities at $31 billion. And then borrowings, this is their long-term debt. Yeah, that is at roughly $42 billion. So Disney having a ton of debt on their balance sheet, and the majority of their assets is actually tied into their parks, resorts, and other properties. Certainly their attractions, building equipment, that is the majority of their assets over at Disney, and those depreciate at a rapid clip. You see over the last year, accumulated depreciation in those attractions and buildings have been roughly $42.5 billion. So again, Disney's assets largely tied into parks and recreation, and then they have a ton of debt still on their balance sheet. They'll likely have to either raise more debt or do share dilutions in order to acquire that remaining stake in Hulu. And again, I don't know if that is the best decision over at Disney. Now, from a cash flow perspective, this company has improved significantly. We have that $3.3 billion worth of net income over the past, this is over the last year. So a 1 year net income from operations at $3.3 billion. We get to add back, frankly, a ton of depreciation and amortization. And so our cash flows from operating activities look fairly good at $9.8 billion. You see a year ago, over the past 1 year, we were sitting at just $6 billion of operating cash flow. So year over year, Disney is improving their operating cash flows, likely due to those cost cuts, and that is helping profitability over at Disney. Now, in my perspective, this company, from a technical point of view, is at an interesting level. Shares are trading near $87 in the after hours, and that is slightly above a key support level at $86.50 I have marked out. And so if shares open here tomorrow and then hold out this level throughout the trade, yeah, I think that can be, again, validated as a level of support. Now, in my perspective, from a fundamental perspective, I wouldn't be overly excited in coming in here, picking up shares of Disney. Yes, the business is improving. Yes, they are striving in the correct direction towards profitability, especially on their streaming business. But considering they have given an outline of Q4 of 2024 when they expect that overall streaming business to become profitable, yeah, I wouldn't be overly excited on a fundamental basis to come in here, pick up shares of Disney, considering their balance sheet is also not in a great position. Now, what I would be able to consider is picking up shares of Disney from a technical perspective. Yeah, if this does validate $86.50 as a level of support, you could come in here, possibly play Disney as a swing trading opportunity if you pick up shares close to $87, $88 a share, and yeah, set a very tight stop loss at $86, maybe even a bit lower at $85 or $84 a share. You could possibly play a write up to $100, so that gives you around $12 of upside and maybe $2 or $3 of downside if you have that stop loss at $84 to $85 a share. Again, not the most exciting setup, but from a swing trading perspective, this does make sense considering Disney has validated this level of support at $86.50 numerous times in the past, most recently back in Jan of 2023, and then most recently acted as resistance in September and October. So again, you could come in here, play Disney as a swing trade considering it stays above this $86.50 support. Now, again, from a fundamentals perspective, I wouldn't be overly excited to pick up shares of Disney. I think over the long term, this company still has a lot of things to correct. And Bob Iger said it himself. Yeah, Disney is making crappy movies. They firstly have to fix that. I think they can focus more on their experiences and parks business, as frankly, that is still generating very strong cash flows. People, even in an inflationary environment, are willing to go to Disney parks. So why not double down on that? In my opinion, the streaming side of Disney currently does not make a whole lot of sense. If you were looking to pick up a streaming play, yeah, I like Netflix a lot better in that sense. That was my take on the Walt Disney Company. Let me know your thoughts in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.